This past week was a risk-off week for me. I got plenty of confirmation of that stance, but most of the carnage was under the covers. You couldn't quite see it if you were just looking at the major indices. Let's dive right in. Here's my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. That is the overbought threshold, 70%. And what you're seeing is how AT50 failed twice at that threshold. Like I said before, AT50 rules say in that kind of case, it's time to be bearish. And it worked out all week long. Market breadth was weak and sold off for most of the way. And it just bounced barely on Friday. Now, like I said, it was hard to see that because look at the S&P 500. On the Fed day, that was Wednesday, it actually gapped higher ahead of the Fed's announcement to a new intraday all-time high. But it sold off from there. And then the next 2 days was weak, but buyers kept stepping in right at that intraday low. Boop, boop, And that says that buyers are really eager to jump in and buy these discounts. The NASDAQ, even more telling. Check it out. The NASDAQ as well gapped higher, but it went right to the intraday high, the all-time high as resistance, came down, but it tested 50-day moving average support, that red line. So that means it's possible that the situation is twisting to a definitive bullish move for the NASDAQ, but we'll have to see because there is a lot of carnage underneath, even for tech stocks, particularly for software stocks. Now, my favorite ETF, IWM, ETF of small caps, it was the big drag on market breadth. It tried to hold 20-day moving average support, that dashed line. It didn't quite do it. I went ahead and did another call option trade. We'll see what happens. Let's take a look at the stocks that caught my interest for the week. There was a lot of carnage. There's a few bright points as well. Let's take a look.